Welcome back. I'm Luke Lloyd in for Scott this week. There's a certain kind of real estate investor who never really sells anything. On paper, sure, properties change hands. The closing documents get signed, the keys get passed across the table, but the wealth, that just keeps rolling. Picture a small rental house bought decades ago. Nothing fancy. Maybe the carpet's been replaced twice, the roof once. Over time, though, the town grows up around it. What used to be the edge of town is now the middle of it. Value climbs, equity builds, and one day it's worth far more than anyone expected. Most folks would cash out and celebrate. But seasoned investors, they think differently. Instead of selling, they swap. They trade that little house for a larger property, then maybe for a small apartment down the road, then maybe that for something commercial. Each move bigger, each move strategic. The portfolio evolves, but the tax bill keeps getting pushed down the road. It's not flashy, it's not loud, it's patient, it's methodical. It's how people quietly turn one property into a lifetime of compounding money. Chris Ward joins us next to talk about that strategy. That is called the 1031 exchange. Chris, thanks for being here today.
Yeah, hey, Luke, man, thanks for having me. Happy to join.
Yeah, I'm looking forward to getting into this because this is a very unique strategy, and you are basically the expert when it comes to this. I know you do this a lot for your clients. Tell me more about what the 1031 exchange is, why it's so impactful, and why people need to really look into this more, especially if you are a real estate investor.
Yeah, I mean, I think this is something where, as an advisor to high net worth clients, I spend a lot of time talking about how you can minimize taxes, effectively preserve your wealth, and then be able to accomplish your goals in the future, right? It's a very complex question. If you have an investment property that you've held for many years, whether it be rental property, whether it be farmland, trying to pass it to the next generation in an effective manner, but still be able to maximize its value today. So the 1031 exchange is a part of the U.S. tax code. What it allows you to do is basically avoid paying income taxes on the sale of a piece of real estate. It allows you to avoid paying taxes on depreciation, as well as avoid the capital gains. Take the entire sum, redeploy it into new real estate properties. So you might buy a new property because you're transitioning to a vacation home and you want to get away from being a landlord. You may want to sell a piece of leased farmland because you're no longer actively using it, and transition into higher paying income properties because you have retirement income needs or you have to pay for a nursing home stay, etc. And so there's a lot of advantages to being able to reposition that investment so that you get a higher rate of return in the future. And I think we can all agree, no one wants to write a large check to the U.S. government if anyone can help it. But there are times when real estate holdings go well beyond the use case and you need to relocate that capital.
That's exactly right. It's all about relocation, and taxes are honestly one of the biggest hindrances to wealth. So this really delays that tax, and theoretically, you could just delay this on and on forever, right? I mean, maybe never pay any tax. You could die with this essentially.
The old expression, right, in the 1031 exchange world, Luke, is swap till you drop, right? So you're just going to continue to reinvest these proceeds and grow your capital. The best example I can give you, right? I did some research today prior to our conversation. The Ohio State University publishes an averaged farm leased rent, right? So what you get cash rent per acre from farmland, and you run around 2% as your gross income amount. And then you still have to pay expenses. You still have to pay insurance, and you may have utilities, real estate taxes, obviously. And sometimes it gets hard to transition to the next generation, or maybe your kids have relocated to the city and they don't plan to farm the land and you're kind of stuck with it. But you don't want to sell it. You don't want to end up writing a massive check. So I've helped clients sell that farmland and go from getting, let's say, 1 to 1.5% on their money as a net result of owning that leased farmland to where now they're getting between 5, 6, 7%. Because you're able to transition into different real estate properties that have better cash flow metrics. And that's going to support your lifestyle at a greater extent, right? And so more income and avoiding taxes is never a problem that a client has come to me and asked me to solve.
That's exactly right. Talking about buying and selling, let's pivot a little bit here out of real estate. One thing you told me you're selling is the Mag 7. I think you sold the ETF that tracks the Mag 7, and you're looking more into gold and international stocks. Tell me about why you're so bullish on international and gold specifically.
Yeah, I mean, there's two main components, right? And I do manage tactical investment portfolios for my retired clients that I work with. And the big component there with international stocks is you have a couple of metrics, right? So one, we all know about the tariff environment that's been created, and the U.S. is a dominant player in the economic markets. But the issue becomes if you force global partners to trade with each other, that's only going to force more activity between those different countries, companies domiciled externally away from the United States, because maybe they get a contract as opposed to paying a 15, 20, 50% tariff. There's more certainty in the economic environment. But besides the point, the other aspect is that for the last 15 years, let's go back to the great financial crisis, right? 2008, 2009. The U.S. stock market has been far and away the best place to be invested. I founded my firm in 21, and we've been underweight international stocks until February of last year when we took an overweight position. And you look at some of the holdings that we own, particularly, we're in the Smart Beta, Schwab, Fundamental International ETF, FNDF, and I think it's up 40%. Since we went into it, and it's up a few points this year with the S&P being negative on the year. So our investors know that our job is to tactically relocate capital when we see an opportunity. And we've been in the Mag 7 all the way from the founding of my firm until today. But some of those valuations are extremely stretched.
When the game changes, you have to change. You have to change with it, right? The game always changes, and international was unloved, but once it becomes loved, you have that quick mean reversion, and I think that's what's happening right now. Chris, a lot of great stuff. Thank you for coming on today.
Appreciate it, Luke. Have a great one.